Hi, everyone. Thank you for joining the main SBDC today. We've got Business Advisor and Portland Center Director, Peter Harriman, here to lead our Pricing Your Products and Services webinar. He's going to be going over a variety of pricing structures and assessment tools. If anyone joined us last week for Lori Allen's part 2 of her Business Reboot webinar, she kind of went into this a little bit, but he's going to go into it much more in detail. So that should be a great follow-up. Please use the chat feature. Introduce yourself. Let us know where you're located, maybe what business industry you're in. If you'd like to submit a link to your business or your store, think of this as a networking opportunity as well. So definitely engage with the other participants and submit any questions you have for Pete there. You're welcome to stick them in there as they pop up. We'll also have time at the end for any additional questions. Otherwise, I will pass it over to Peter.
Hey people, how are you all doing? Let's play The Price is Right, okay? I never had an introduction like that, but I love it. My name is Peter Harriman. I'm gonna reiterate kind of what Kelsey just went over, but this whole course was designed to help you understand some of the components and some of the aspects to think about how to break down your product or service prices. Right, this will be recorded, so I know there are a lot of people that signed up and emailed me and let me know that they were going to be looking forward to the recording but couldn't make the time. So it will be recorded. Participants will be sent a link, and otherwise the recording will be put on our website as well. And just to reiterate from what Kelsey said, any questions at any time, please feel free to put them in the chat. I might not get to them right when you ask it, but at the end I do have some time put aside to answer questions. So please feel free to do that. Basically what we're going to go over is who we are and why we're doing the presentation. We're going to very briefly touch on wholesale versus retail, because when I went through the list of participants, we have a mix. So very quickly go through benefits of wholesale and the differences of those. Then we're going to jump right into pricing and go through the 3 main points of how to determine your price. Of course, I'd be remiss if I didn't add a slide or so about COVID and how that has affected pricing as well. And then again, we'll have some time for wrap-up questions. So who am I? Who do I work for? So I'm Peter. I work for the Maine Small Business Development Center. I'm a certified business advisor and the center director. We're hosted by the University of Southern Maine, and typically we'd have an office right at the university campus on Portland, but during this time we're doing telework. As you can see, I'm in my basement, so like many of you, we're at home. But what we do is we offer free confidential business advising, whether you're in business, looking to get started in business, or any mix of the two. We help with business planning, we help with startups, we help with understanding financing or expansions. I've been getting a lot of HR questions lately, or many questions on the PPP program that was pretty popular a few months ago, or SBA loan products, also financial analysis, marketing. So we try to be able to at least offer resources to you if we don't have the answer, right? We are not your legal or tax. So I get a lot of questions, and I can give you what I've seen or examples of what I've seen in the actual world and what we've encountered. But if you have a question on a contract, that should be something you discuss with a lawyer, or you have a question on what form do your taxes on, that should be a lawyer or an accounting question. So we are not a substitute for legal or tax advice. We do have advisors covering locations throughout the state of Maine. Again, not as important in COVID world, but if we do get back to a normal, if you see the map, you can see that typically wherever you live, there's somewhere, an office somewhere near you that you could actually go and see an advisor and sit down with them. But right now we're doing all remote advising through Zoom or emails or phone. And that tends to be working out pretty good. In 2019, we saw about 1,500 clients, created or saved 600 jobs, helped push 26.8 million in capital generated, and helped start about 133 businesses. So again, we're not just business startups, but every few days, if you do the math, we tend to help a business start who wants to start. All right. Now, Maine is the jackpot for resources. Remember, if I can't answer the question, I'm going to try to find someone who can. And that's just like what every other advisor does. So in our Jackpot of Maine raffle here, we have the SBDC, of course. SCORE is another great resource that we have in the Women's Business Center, both free confidential advising services as well. And we often find that clients can use multiple services at once. It's not a pick one and you have to stick with one. It's you can use multiple services as you go. And those three tend to be under the SBA umbrella, but there is the SBA, there's Top Gun, Upstart, New Ventures, there's many resources in Maine, and I've dealt with, especially in 2020, where we've got a lot of new people moving into Maine. A lot of them, that's the first thing they comment on is how many resources we have in Maine. So we have them, so use them. Please reach out to us. There's a request advising button right on our website, or reach out to one of the other ones. We're very collaborative community here. So let's just jump right into the, enough with that. Let's get to the meat of the bones. So as I said, we're very briefly on wholesale versus retail. Retail's where it's business to consumer, right? Often called B2C. You are directly selling to the end consumer. There's no middle person, so to say. And that's either products or services. So most service-based businesses could consider themselves retail. They're service-based businesses, but they're directly to consumers, right? And then wholesale is when you are selling to a retailer who is then going to sell to a consumer. So oftentimes they also are called B2B, business to business businesses. And with that, typically your product is priced below what the retail or the suggested retail price is, because that retailer then has to mark up your product to make their profit, to pay for their own expenses in selling that product. So there is a slight price difference with your business structure, whether you're retail or wholesale, and we'll mix that in throughout the presentation when we're doing wholesale, retail, and what that means as you go through. Wholesaling is not consignment, and we'll get to that in a second. So why would someone want to wholesale? With a wholesale, you're not typically keeping large inventory on the shelf, right? Yes, you have some inventory for samples so you can help sell your product when you go to talk to the retail stores, but typically you're only going to have the inventory that you need to market. Otherwise, you're going to make the inventory as you get orders in, right? So you don't have to keep a whole bunch of inventory on all these shelves and all these stores or anything like that. It also allows you to increase exposure. So if you can get in the LL Bean catalog, that might be a lot more marketing than you could have done on your own. So there is a benefit to wholesaling there. And it's got, or you have more control over the schedule or the revenue stream. So you can start placing orders, okay, I'm gonna have 30 orders this week and 10 next week, and I've got 20 for next week. So it's a little more predictable than people just randomly walking in or going online and buying your product, because typically orders are placed in advance. Okay, so there are some benefits to wholesaling. Remember, wholesale is not consignment. So I do see consignment come in sometimes where consignment is usually higher priced items. So the one that pops in my brain all the time is paintings. So an art gallery will have an artist come in and they will help sell that painting for the artist, but their art gallery itself is not buying the painting typically. Typically, it's going to help sell the painting. It'll run the whole commission structure and figure out its cut and the artist's cut, and that's more consignment, right? The difference being that cash flow is a little more unpredictable, and you do need to tend to put large portions tied up on store shelves so that that painting is in the art gallery, and it's not necessarily being sold yet until it gets sold. So you have to keep all the inventory in the stores, just like if you're stocking shelves. Also, some question on the insurance. If the store burns down, do you get paid or not? What's the liability there? And the trust that the store is going to accurately tell you when they sold the product, right? Again, there is exceptions to that, but typically I see wholesale and not too much on consignment unless it's higher priced items, right? But this presentation is geared more for the wholesale, not the consignment. To wholesale or not, you'd have to really look at your business and understand your business on your pricing, and we'll get to the pricing on how to get to that. Remember, the retailer that's going to ultimately sell your product to the consumer is going to want to mark that up. So is there enough room in your price to mark up to be able to wholesale? Do you have the capacity to fill orders if you suddenly get a lot of orders, right? Because remember, your market, if you're in a catalog, you might get many, many more orders than you would have if you were just in a small store in Buxton, right? Your marketability, you want to have popular items. You don't want to necessarily sell the unpopular items because it's going to be very hard to move. And the identity, and we're seeing this much more often coming up. Do you identify with who the ultimate retailer is? Have they done something, whether it's political or otherwise, have they done something that maybe doesn't jive with your brand, right? So if I'm selling candles, maybe they'd fit with LLB, maybe they wouldn't. So where are my core clients going? Does it jive with my identity? So they're going to be able to find me, find my products. Again, we can get into wholesale and retail much more, but I want to make sure we just have that base there as we go through, because I do try to incorporate the wholesale into the pricing. So pricing itself. Pricing is complex, right? Anyone who tells you pricing is easy is either not understanding what goes into pricing, and you as a business owner understand very well that pricing is like one of those things that you don't like to do because it's pretty hard because you got a lot of things to think about. You have pricing techniques, pricing strategies, which we'll get to some strategies at the end of the presentation. We have target markets, competition, company image or positioning, distribution channels and how those work. Will that increase or decrease your price? And your material, labor costs, and supply, right? There's a lot of things that are going to go into pricing, and it's a very complex subject. If you're not putting a lot of thought into pricing, then maybe this is the time when you should, right? And I said, we're going to get to the pricing techniques and strategies, but pricing strategies is different than price point determination, okay? As I said, later in the presentation, we're going to go through strategies, but strategies is a marketing tool that's going to help you sell. And there's a lot of them out there. Price point determination, what we're trying to do first, is the active understanding at what price you need to have your product in order to sell, right? So first you need to understand your price point, and then you can come up with your pricing strategy. And I said, I'll have some examples. So there are basically 3 classic categories of how to determine what that price point is, right? And we're going to walk through the first one. We're going to spend the most time on that one, right? The first one is the cost basis. How much is it actually costing you to provide your service or to make your product, right? Once we understand that, and usually I like businesses to go in this order. Once you understand that, then you're going to look at your market basis, right? What is my competition able to offer a similar or the same product or service at, right? And that's going to tell me if I need to relook at my cost basis, right? And third, market acceptance, right? So this is your customer perception. Just because you have someone who's competing with you doesn't mean you have to be the exact same price, right? Your customer might perceive that your product is more valuable and you could charge a higher price. And I often see what I call the Walmart effect, where a business will feel like they have to compete with the prices that they find at Walmart. And that's not necessarily true if you're able to differentiate yourself. And we'll get into some ways that you can have a different price and be okay. Right? As I said, we're gonna spend most of our time though on this cost basis. Right? So how do you determine your minimum price, the cost basis? Right? We're gonna break this down into 4 steps. And technically there's a 5 steps if you're wholesale, right? And we'll get to that. But the first step in understanding the cost basis is understanding what is my direct cost, right? And this is your material costs, your ingredients costs, your labor costs. And when we say labor, we either mean how much do you have to pay someone to do it, so your manual labor there, or if you're doing it, if you're a very small operation, it's just you, if you had to pay someone to do what you're doing, how much would you need to do it? Because labor is one of the tricky things where when a business first starts, I often see a lot of businesses who give free labor, right? They don't put labor into their pricing. And then it ends up biting them in the end because their product is less expensive, or they're not charging as much as they should be for their product because they didn't incorporate any kind of labor pricing. Now, I'm going to put a little star by labor because there's 2 ways you could do labor. One is you can do it in the direct cost. And that would be if you knew exactly how much time it took to make each product or to do each service, right? So if you knew, hey, my service is an hour long, I'm a massage therapist, and I know the amount of oils I use, and I know that it's an hour long service, then that can be in the direct cost. But let's say you are a baker and you have a lot of different things that you're baking at once. It's very hard to say, how much time went into making that one muffin, right? In that case, labor might better be served in the indirect cost, which we'll get to in the next page. But when we're talking labor in the direct cost, that's when you can attribute a certain amount of time to each product, because that's what you're trying to do. You're trying to break down what is the cost for each product. And it's not just materials, ingredients, and labor. Right? In the bottom there, you can see there could be packaging, there could be labeling, right? If you have boxes that you're going to ship in, because a lot of people are doing e-commerce these days, you're going to have that label, the packing material, the box, the postage. That is going to be something that you're going to want to incorporate into your cost, and you want to know what each one costs. Now, with a bakery, for instance, you could run a whole batch. I could make a whole big batter for 18 muffins. Well, I'm going to keep track of everything that I'm putting into that batter. I'm going to make the 18 muffins, maybe timing myself to see how long it takes. And then I can tell whatever I put into that divided by 18 is what each material or ingredient cost is for each muffin. So I can break it down into the nitty gritty, right? Now, some people like that level of detail. Other people might use just a percentage, right? So what I mean by percentage is they will figure out, okay, my food cost should be 20% of whatever I end up charging. So this is mostly for people with food-based businesses. In that way, that kind of encapsulates any kind of spoilage you might have, because you might not use all the butter. Maybe some of it goes bad or whatnot. And it kind of gets you a ballpark. Doesn't work necessarily for manufacturing. Manufacturing, direct cost is great. If you're manufacturing little widgets, you know exactly how much wood or metal goes into each product, so you can get to the fine-tuned details. So when I say direct costs, you do have to look at your industry and look at the time that you're willing to devote to it to understand how nitty-gritty you're going to get for this level. But I usually advise people get as nitty-gritty as you can, because it's very important you understand what the costs are. So step 1, what is my direct costs? Step 2, and this is the hardest one. what is my indirect cost, right? Indirect cost is often overlooked. Indirect costs could be your insurance that you have to buy, fees that you might have to pay, taxes that you pay, rent, utilities, right? You have to pay for that, and you pay for that by selling your product or service. So you need to incorporate the cost of that into your price, right? And it's hard, especially if you're a new business, because you're going to have to project what those costs are going to be, and you're going to have to project what your sales are going to be, because you're going to take the total annual cost and divide it by the total annual sales to understand how much you're going to have each product cover for your indirect costs, right? Existing business, you can use your historical, right? You can pull up your history and you can kind of understand how much your cost is going to be and how much sales you're going to have. So that makes it a little easier. But a new business, this is very hard because you're dealing with two best guesses of annual cost and annual sales. But again, what we're trying to do is we're trying to understand what is all the costs that were not included in direct costs. We don't want to double count stuff. What is all of the indirect costs that there is to run my business divided by how much I'm going to sell, right, in units. So in this example, if it's $10,000 per year is my overhead cost, my indirect cost, and I'm selling 2,000 units, then I know the indirect cost should add $5 per unit, right? And if I add $5 per unit and I sell 2,000, it's going to get me the 10,000 I need to cover my indirect cost of the product. Right? And so what we're doing is we're starting to get a little tally sheet as we go through each of these steps, adding up all these costs, because at the end we're going to have our final product, right? Now, as I said, if you're a business owner and you don't necessarily know how much time it takes for direct cost labor, your overhead cost could be where you put your labor in. So if you say, okay, I know I want to make 35,000 for the year, then you can include that 35,000 in your overhead indirect cost, right? Divided by the units, and then you know how much you need to charge for each unit to make sure you're covering your overhead. And the most common question I get at this point is, well, what happens if you have more than one thing you're selling, right? Because this is a pretty slimmed down version. You might have multiple products that you're selling for different prices, right? So we're going to just throw out some numbers here. So let's stick to the $10,000 of annual indirect costs. We're going to stick with that. And we're going to say, we're going to think we're going to have sales of $20,000. Now, why I switched from units to numbers is because your products might be sold at different price points, right? So we have 3 different products. And when we look at that breakdown of sales, we find $15,000 worth of our sales is product A. Product B is 3,000, product C is 2,000. Remember, it's just fictional, but you can go through your different products and understand, or your projections, and understand, okay, this is the percentage of what I think my sales are going to be. Because once we get that, we can understand, okay, how many units are we talking about? There's our percentages. So the portion of indirect cost for product A, right, we're selling a lot more of them. We're selling 5,000 of them, so we only need to increase the price of product A $1.50. If we increase it $1.50, it's going to come up with the $7,500 that we're going to need out of that 10,000 to make sure we cover our indirect costs, right? Or product B, we're going to have to, because there's not, we're getting more sales, but the units, so 15%. So we're going to have to do $15 a unit. So that's going to increase the price of that unit by $15, right? Or $15 of that profit needs to be sent to to cover the indirect cost, the overhead. So as you can see, the top portion, that equals to 20,000, that equals the sales, and we broke it down. So at the bottom, that equals the indirect cost, right? And we know how much per unit we need to add if our sales are true, right? That's the hard part. we're assuming sales, and this is where projections, you're always doing projections, whether you're a new business or an existing business, you always need to do projections on what your sales are going to be. Because without understanding what your sales are going to be, it's very hard to do this part of the calculation of understanding your costs, right? So once you understand what your sales are, what the breakdown is, then you start to understand how much each product has to bring in to cover your indirect costs. Now, the only ripple in this effect here is a pricing strategy that we'll get to at the end, right? Right now we're just trying to get to the cost so that we understand what the cost is, what our floor is to understand what profit we need to make. At the end, I can go through a pricing strategy where sometimes it might behoove you to actually put price under that floor as an incentive for people to come in and buy it, and then you're hoping to sell other products or bundle them with other products that might make you more. So that's a pricing strategy. We'll get to that at the end. So right now, what we're trying to do is we're trying to break down our indirect cost per units that we have for our revenue to understand how much of the price of our indirect product covers the indirect costs. Right. Step 3. Again, a step, remember we had 4 steps. Step 3, needed profit, right? So your equipment is going to need to be replaced, or you're going to want to take a vacation, or you're going to want to expand at some point, right? So step 3, needed profit. You need to factor in or bake into your price a needed profit, right? That's the whole reason why you're doing business. You're not doing it just to get by. You're doing it so that you have, you're making money, right? And usually, and this is where SBDC could help, we can pull a report on what is a typical profit for your industry, right? So a lot of people look at that typical profit and they'll say, well, that's good. That would be a good profit. If it's 10%, great. I would love to have a 10% profit above and beyond. Remember, this is above and beyond your expenses, and in your expenses should be your labor. So this is above and beyond labor costs, right? So you need to remember you're making a profit. That's why you're in business. Number 4, taxes on the needed profit. So anything above and beyond, you're going to pay taxes on, right? And your taxes can be 25 to 30% of your profit, right? Remember, taxes are your sales revenue minus your expenses is your profit, and that profit is what you're being taxed on, right? So I advise people that could be, I mean, 25% is a serious chunk of change. Factor that into your pricing so that you don't have, I had this one business who was like, yeah, we made $40,000. And then, a couple of weeks later, like, yeah, we made $30,000 because the taxes got taken out of it, right? So put that into your consideration for pricing of you're going to have to pay taxes on the profit. So only the profit, not the sales number, but the profit number. So put that into your pricing, because 3 and 4 is going to combine to make your profit margin, right? The retail versus wholesale adds a 5th step for some of you, right? Can't remember. I went into a needed profit, just to beat a dead horse. So some people find the average net profit margin of the industry and start there as a markup, right? So if its margin was 10%, they'll mark up 10%. So that would be just multiplying 1.1, right? But I was saying that the 5th step, I don't think I did a slide for it, but the 5th step is that retail markup. And when you go from wholesale to retail, different industries have different what we call keystones, but the typical keystone is 2. So typically, if you're selling something for $10, they're going to mark it up to 20, right? So the suggested retail price that a consumer sees is going to be 20, whereas you sold it to them for 10 because they're going to want to mark it up and get their profit. But each industry is different. So jewelry, the markup is crazy insane. Whereas if you're selling stuff in a convenience store, the markup's going to be much, much less. So you do have to understand your industry, and you have to understand what profit you're going to need, right? So let's get a little more into markup, okay? So how do we figure out what our markup is? So markup basically is your selling price minus your cost, right? And this is where we start to get into the math. This is where people really thank me that it's recorded so they can come back and watch it again, so they kind of get it. So we have a markup percentage is your sales price minus unit cost over the unit cost times 100. Right? Now we're starting to get into math. So for example, if your product costs $10 and the selling price is 15, right? That's 15 minus 10 up top divided by 10, the unit cost. So that markup is going to be 50%. Right? Now, why does this matter? Why are we trying to do markup? Because you're going to often hear about markup when you're selling products, but markup is not gross margin, right? In number 3 and 4, when you had your profit and your taxes, that was your gross margin. This is not what we're talking about. We're talking about something different. The markup is the difference between a product selling price and cost as a percentage of the costs of the product, right? Versus your gross margin, which is the difference between a product selling price and the cost as a percentage of revenue. And I got some examples, because just reading that, you're probably not going to grasp it right away. So an example is, if a product sells for $125 and the cost is $100, the additional price increase means a 25% markup. But gross margin, it means you got a 20% gross margin, right? So markup is almost always higher than gross margin. Right? Now, the difference being is when you're talking, especially if you're in wholesale and you're talking to a retailer, they often are going to ask you, what's your markup, right? And that is what they're asking. They're not asking for the gross margin. That's why I'm kind of explaining them. They're not the same. They're slightly different. So if someone's asking you for your markup, understand what markup means. If someone's asking for your gross margin, that's different. Typically, they're not going to ask you for the gross margin. They're going to ask you for your markup. So looking at it visually, again, I like to beat it with a dead horse. But markup, either wholesale or retail, we got the 25% of original cost of 100 is added, making 125 total, right? Whereas gross margin of the 125 total, the $25 is just 20%, right? And so when you're talking to retailers or wholesalers or whatever, you might throw these terms out. So it's important that you know which term is which and what it means and how it does with your price. So in the best experience is to play around with a few of your prices to understand what that markup and margin is. Again, why I'm saying this is oftentimes you can get industry information on what the typical markup or the typical gross profit margin is and be able to look at your own pricing and understand, is my markup right or is my gross margin right? I mean, understanding the difference between the two and how you get there is how you can take that data that you get from whatever source and you can incorporate that into how you get your pricing as well. I did have step 5. So wholesale to retail pricing, Keystone and markup percentage. So again, the Keystone is typically 2 times the price, right? There is something called triple key and key and a half, which is wholesale price times 3 or 2.5. It's the Keystone, which just stands for 2 times the price. That's the term. That's just the rule of thumb. So if you're looking at going into, you're selling retail right now, you're looking at getting into wholesale, you have to look at your price and say, is there enough profit margin there for me to sell it to them at twice the price, or sell it to them and they can mark up to twice the price? So if I had a pen and I can make it for $1, but I'm selling it for $2.99, that's $2 profit that I'm making. off of the cost of the dollar. So if I were to sell that in a catalog and they sell it for $2.99, am I making enough profit there for that to be there, right? So that's just for people who are thinking about going from retail to wholesale, right? Each industry has its own markup, but the keystone, the rule of thumb is 2 times the industry, right? So how do you calculate the retail price if you know the markup percentage? Okay, so this is, you had all those terms thrown at you, and now we're going to try to put it into practice, right? So how would you calculate the retail price if you know the markup percentage? So the retail price is calculated with the following formula, right? Wholesale price times 1 plus the markup percent equals the retail price. So here's an example. If there's a wholesale price of $30 and a 60% markup percentage, we'd convert the markup to a decimal, add it to 1 to get the multiple of 1.6, and multiply the wholesale price by 1.6. So the answer is your retail price would be $48 on a $30 wholesale price, right? So again, explain the terms, and now this is how the terms come in. So if someone's asking you what your markup percentage is, if you're looking at wholesale retail, this is what you can tell them. You can say, oh, my markup percentage is, if I'm selling at 30 wholesale, my markup percentage is 60%, which means it'll be a $48 retail price. Different than if they're asking you what your margin is, right? So using the same numbers, but going through with margin, right? You're going to get to a $75 retail price. I won't go through the math because it's right there. So knowing the difference between the two in what you're being asked will help you understand what that price is, right? And this is also going to help you when we're looking at competitor information as well. If that, that all got all convoluted really fast, there are some websites to help you with markup and with margin, right? And these slides or this presentation will be available to you so you can get that as well, right? So there's some for markup, there's one for margin, and then there's a website that does both markup and margin. So you can enter your price, you can enter your markup or margin, and that'll go through all the math for you, right? So let's step back at this point, because there's been a very condensed amount of information just thrown at you in a very short time. So let's step back real quick. So all the steps on one page. 1A, materials or ingredients direct costs, right? And I divided 1A to 1B, labor costs, because labor might be something that you could push down into overhead costs. So I want to make sure we got that distinction there. Labor doesn't necessarily have to be a direct cost. It might be an indirect cost if you can't tell how much labor per unit, right? So direct cost. Then step 2, indirect costs. What's your overhead? And that's the hardest one to figure out for a business because you're projecting, you're trying to estimate what that's going to be. You can use historical if you think your business is pretty stable, but again, that's the hardest one. I put a line there because up to that point, you're not making any profit, right? If you just sold using the pricing of breaking down your materials cost, your direct cost, and breaking down your overhead costs and putting that all in. At that point, if you sold at that price, you're just paying for your cost. You're just paying your direct and indirect cost. You're not making a profit. Okay? Anything below that line is where the profit comes in, right? So your needed profit, your taxes on that profit, and if there's that retail markup, then you can go through that as well on what that means. Okay, so let's get all of that with numbers. I'm a person that really needs to see actual numbers to understand what's going on. So let's say we had earrings, and the materials, ingredients, and packaging that we had to put into earrings is $7.35, right? And let's say we did decide we could understand how much labor went into the earring, and we didn't want to push that into indirect cost, right? So let's say it's $12 per hour that we pay someone, and it takes 60 minutes to make 3 earrings. So that comes out to $4 per earring, right? So we understand the direct costs. Then we get to the overhead costs, right? And a lot of people like to break it down to monthly because they understand what their monthly costs are, and then they just convert it to annual. But let's say there's an $800 monthly cost and you're selling to about 40 customers a month, right? 10 customers a week, and it's constant throughout the year. And that's why I like the annual, is because it's not usually constant throughout the year. There's very much a seasonal cyclical pattern to most businesses. So if you do it annual, that gets rid of that pattern. But let's say it's constant throughout the year. So that's going to add, the indirect overhead cost is going to add $20 per earring, right? So at this point, so far, if we were to sell each earring at $31.35, we would not make any money, and hypothetically, we would not lose any money as long as we captured all of the indirect and direct cost, right? But we're not making a profit either. We're just paying our expenses at this point. So then we're going to add in the needed profit, right, as a markup. So 20% markup, right? We did our research. We found out the industry average was 20%, let's say. So, and we found it was markup and not margin. So we did all that calculation. So that brings it up to $37.62. Then we want to make sure that we pay the taxes on that, right? And if you do the $31.35 minus the $37.62, there's $6.27 difference. So that's the profit that we're talking about. So there's going to be $1.57 in taxes you're going to pay on that profit. So we're going to add that together. So $39.19 would be, at this point, hypothetically, what you would want to pay. That would include your direct cost, your indirect cost, the markup that you're happy with, if you're happy with that 20%, and the taxes on that. Now, marketing strategy would tell you, okay, maybe I can get away with $39.99 rather than $39.19, right? Because people are used to $99. But if you were selling directly to the consumer, that would be the price that you'd want to sell to get everything you want. Could you go up in price? Yes, maybe. That's the following steps of competitor research and what your clients are willing to pay. But right now, the important information is we know that we don't want to go under $39.19 at this point, because if we go under $39.19, we're losing money, or we're not making as much profit as we wanted to, right? So that's why this is important. Doesn't mean that this is what your price is going to be. It's just a piece of information for you to help you make a decision of what your ultimate price will be, right? Now, if we had that extra 5th step and we did a Keystone for jewelry of 2 to 3, right? That means that earrings would be about $78.38. But, you know, because of marketing, it's probably going to be $79.99. So there is that understanding, okay, if I was a wholesaler and I sold it to a jewelry place, they're probably going to mark that as $79.99. And that's important to know, because when I approach that, if I'm a wholesaler and I'm approaching that retailer and I said, oh, my earrings are $79.99 and that's what I think people will pay for it, that retailer is not going to want to buy them, because they'd have to then mark them up, you know, 2 or 3 times to be able to make their profit, and no one's going to buy the earrings for twice that much, right? So there, you have to put some forethought in if you are planning to do wholesale in the future, right? You're going to want to start implementing a price strategy to make sure that retailers will want to sell your product, because retailers will not want to sell your product if someone can get them for the same price or cheaper on your website versus in the store with them. Now, there's some problems with cost basis pricing, the first step that we're doing of the pricing webinar here. Knowing the true direct cost, because as you know, if you order more, that can lead to a decrease in cost, right? And oftentimes I see some people go through different scenarios of, oh, if I order 1,000 units, it's this price. But if I order 10,000 units, you know, the price is less, right? So that matters. And you might have to run a few different scenarios based on savings as you order more units. You don't want to go too far. You don't want to have a year's supply of stuff necessarily, unless you think there's going to be a bottleneck in the supply chain management. But you do want to keep in mind that different quantities might get you different discounts, and that is going to affect your true direct cost, right? It might be a cost savings to you. And the other problem cost basis that we've been kind of hammering in on is knowing how to apply those indirect costs, right? So it's projecting your sales and projecting your costs at the same time, because you have to understand how much you're going to do in sales to understand how much of those sales will need to be covered in the costs, right? To cover the indirect costs that you have. So there are two things to watch out for when you're doing the cost basis: those volumes and scales that can get you a lower price, a higher discount, and the fact that the indirect cost is the hardest to calculate because you might be guessing on some of those, right? But once you establish your cost basis, then you can turn to competitor pricing, right? You can determine the market basis competitor pricing. And we're going to do market acceptance. We'll get to that in a second. Let's dive into competitor pricing first. Market acceptance is what your core client perceives as the value. So with competitor pricing, you know, if you go out there and you find a similar product or the same product, depending on your business, and this is a service or a product, I know I say product a lot, but you're going to look at your competitors. You're going to see what they are charging. You don't have to necessarily match it. You just need to know, if I'm a consumer and I need this want or need filled with a product or service, what's my options for that? Because the competition is for the dollars. It's not for the product or the service necessarily. It's for, if I had money to spend and I wanted to fill whatever void, or I had whatever need, what is my options out there, right? Secret shop, open shop. Most businesses are open about pricing because they want people to buy it, right? So if you tell them you're going to buy it, they're probably going to tell you the price so that you can buy it. So find your competitors' pricing, right? This is the hard part. Finding how much of a margin or markup is typical in that distribution channel, right? So what is a typical markup that is in your industry? Because we're going to try to reverse engineer what our competitors' pricing is at, right? Keep in mind that there are some drawbacks to this where we don't know what is going into the pricing necessarily of a competitor. So as we get into this reverse analysis, there are things that could throw it off. If your competitor has a lot of debt or doesn't have a lot of debt, let's say the competitor owns all of their equipment and all of their building all outright, so they don't have a mortgage and they don't have that overhead cost. Well, they can offer a lower price than you can, right? So as we do this reverse engineering, remember, this is just a part of the story. It's not all the story, but it's just going to try to help you understand your competitor pricing, right? So we're going to reverse engineer the retail pricing of the competitor, right? And we're going to assume that the competitor had a retail price of $60 and that they get an 85% retail markup, right? Slightly less than Keystone. And the wholesaler has a 20% wholesale gross margin. And you can use this formula to work backwards and calculate the wholesale price. And that's a whole bunch of math right there, right? But you can get some of this information online as just general industry statistics, right? The price you get directly from the competitor, but the other information you might be able to get just as general statistics online, right? And once you have that information, I won't go through that, but you can start to understand, and in this example, it's a wholesale to retail price, but you can start to hopefully understand, what does my competitors' pricing mean? Where are they at for a cost? Because really what we're trying to get to is, how much is it costing them? How much of a markup do I think that they're charging? Because I really need to understand, where's my pricing at? Am I asking too much of a profit? Should I come back on that profit? What does it all mean? Step 2 of reverse engineering is, let's calculate the wholesale margin to get the actual cost, right? So, and again, this is if we had a product on retail and we knew the retail price, we work backwards to get the wholesale price, Which the wholesale price is not the cost price. The wholesale price is what the one business is selling to another business. So now in step 2, we're going to take what the wholesale price is that we got. We're going to work backwards using all the industry data that we might be able to get either from the SBDC, from SCORE, from whoever. We're going to work backwards to try to get, okay, what do we think their target cost was? So now we are getting to what we think our competitors might be costing it out as, right? So in this case, again, with all the math, you can read it as well, we got a $25.94 target cost. So hypothetically, that $60 item that we started with, that we found out from the competitor, okay, I'm selling it for $60. If we wanted to, and we did all the math, we could find out if they bought it wholesale, that wholesale cost to make that item should be around $25 to $26. So then we can look at our own cost and say, well, what is my cost to make that item? Do they have an advantage over me? Is the item on the same level, right? Are they able to do the forward thing and just have a factory that pumps out items so their cost per item is much lower than mine? Is mine handcrafted, so maybe my cost is higher? Remember, these are just all data points to help us understand how the competition might have gotten to their price, right? And how I should react to that price with my product or my service, right? Because once I understand my competition and how they got to their price and I reverse engineered that, then I'm going to turn and I'm going to look at my customer perception, right? And this is where you really have to understand your core clients, right? What price are they expecting to pay? Because this mismatch in value to price could be troublesome, right? So if someone comes into a BMW car dealership and they see a BMW for $10,000, they're probably going to say, well, is that the lemon of the lot? Why is it so cheap, right? So if your price is too low, that could be a problem. If your price is too high, that could be a problem as well. Too high or too low compared to what your core clients are willing to pay, not your competition, right? We already did the analysis on the competition, understand where they're at and what choices are out there and how the competition came up with their price, right? Now we're looking at what my clients are willing to pay, right? For instance, the Apple iPhone has a total production cost of $490. That's all it cost Apple to make, market, and ship, right? But they're retailing it for $1,099. If they were to sell it at $500, people probably wouldn't buy it because they're expecting Apple products to be higher. So remember, we're trying to match your core clients' expectations with the value that you're offering them. And it's not, we're using the competition as kind of like a guide. Okay, a cheap quality product should be this, a high quality product should be this. So we have this range of what the competition is at, but we have to understand our clients, our core clients, to understand, okay, what is my core client willing to pay for my product, right? Is there some kind of value to them that I can then market? Is it handmade? Is it customized? Is it mass produced? Is it safer? What is it? What can I have for expectation for price? So then we get into pricing strategy, right? So there's pricing strategy comes last. You have to understand how much your core clients are willing to pay for stuff. You have to understand what your competition is out there to understand what the market looks like. And you have to understand your cost basis first before you start implementing some kind of pricing strategy, right? Because a pricing strategy means you're actually going to move your prices around to get the most marketing buck, right? Most bang for your buck. So you get pricing strategies like Walmart. Theirs is a low price to capture market share, but there's not a lot of customization and maybe not a lot of quality in it, right? They're just they're looking for the mass produced stuff on average. You're not looking for custom stuff when you go into Walmart, right? But it's intentional. They're trying to do market penetration, a lot of stuff for cheap. That's their pricing strategy. So their profit margins are pretty small, and they're okay with that because they're selling so much. That's their strategy. Or you got a market price skimming strategy that Apple does. And that's when a new product comes out, that product is a higher price, right? Because it's new, and the one that used to be new that became old, that price goes down, right? So every time a new product comes out, it goes to the top of the list of the price, where the other products then start moving down in price because they're starting to fade away. They want sales to fade because they want to put all their effort into the new one, right? So that's what Apple does, and I'm sure many, many more companies do. Or location pricing, and this is often with stadiums, right? When we go to stadiums again. So if you ever bought a hot dog or a beer from at a football or a baseball or a basketball game, you know you're paying a premium for getting that beer in a stadium, right? Being able to have it there. Or if you go to the movies, there's a convenience factor of having the popcorn right there. And they don't allow you to bring it in, but so they are able to dictate that price. Or bundle pricing, and we often see this with internet or cable. And this is where you can take a product that is a good seller, but maybe a lower profit margin, right? Because maybe there's more competition, you can't charge as much, but you can then bundle it with one that you make more profit on, right? So you could actually intentionally lower one price, because if you bundle it, you're going to make up that lower price with how much you make from the other product, right? So there's a strategy, lowering it, bundling it, and selling it as a package, because overall you're going to be able to move that higher priced item a lot more if you bundle it. We see internet and cable TVs do that all the time, right? Other strategies is the psychological pricing. If you ever see the 99 cents at the end of anything, that's because they thought if they went $1 more, they'd lose a sale. Or the buy one, get one free deals. Those are all emotional drivers to get you to buy, right? Perceived value or prestige pricing. That's the BMW example, the Rolex example, the Coach. They've built a brand name enough, and that's what your strategy could be, is I want to build a brand name where my price is based on value and prestige versus my competition might only be mass produced or uncustomized stuff. Price lining, and this is with vehicles often is the best example I can think of. So if you go to the vehicle lot to buy a car, you've got the base model, and then you have different model options based on what options you want. So with your product or your service, you could have your base, and then you the upselling, right? You have a different versions that might be more costly as you go up. So you get them in the door with the base model or the base service, and then you can try to upsell them to different options. And that's what a lot of car salesmen do, right? And finally, competitor pricing. Right? So you might be in such a competitive environment that you have to do competitor pricing. So that would be like a gas station. There are so many gas stations out there. You can't really afford to be a gas station and charge more for your gas, because I know people who will drive miles for a 2-cent difference in price per gallon. So if your competition, there's a lot of it, then it might be that you have to match their prices, and then you try to get them to come into the store, for the gas station example, to buy stuff that are higher priced, right? Now, some red flags. Red flags to know that your price is too low. One, you get a high percentage of your orders. And this is hard for a business to really wrap their head around at first. You do not want to sell to everyone, right? Yes, it'd be great if everyone bought your product or your service. That'd be great. Not really saying that. But your target is not to sell to everyone, because not everyone is going to want your product or going to want to afford your product, right? So if you're getting 100% of your sales, that should be a red flag that your price might be too low. Okay, so if I often ask contractors, like, oh, how many of your bids do you get? How many of your estimates that you send out do you get? And they're proud of it. They're like, I get every one. I don't lose a bid. I say, well, you're probably too low then. You should be losing some bids. You should be losing some business. There's something called the 80-20 rule. 80% of your business usually comes from 20% of the clients, right? So you are trying to focus, and that's the whole point of getting core clients. Not everyone is going to be your clients. You really need to focus on your core clients. That's who you're going after. And not all of your core clients are going to come, but you're trying to find the core clients, and that's who you're marketing to. If you sell out of your product, well, your price might be too low. The exception is supply and demand, toilet paper. If there's some kind of run on your product, that's good for you in a way, but that might be a temporary thing. But if you're constantly selling out your product and there's no special event that's going on, that might tell you. Or if you're a service-based industry and you find that there's a long wait list for your product, that's a red flag saying, and that's the next one, lead time stretches out. That's a red flag that your price might be too low. Your profit margin deteriorates. So oftentimes I get a business that comes in and I ask them when the last price change was. And they think about it and they say, I don't know, 3 to 5 years ago. Well, has your insurance gone up? Has other costs gone up? Yes. I mean, just inflation itself has gone up. So I always tell my businesses, people take small changes a lot easier for price changes than they do large changes. So don't wait 3 to 5 years before you change your price, because that's just going to eat away at your profit margin because your costs are going up. Try to implement some kind of routine price increase with your product or your service, right? And depending on your product or service would be, is it something that happens every quarter, every half a year, every year? What is it? But the example we always give is Dunkin' Donuts, right? A Dunkin' Donuts medium coffee used to be $1.50, like 10 years ago. Now it's more like $2.50 to $2.80. And over that time, it's slowly increased, right? Because they just put it into their price structure. We're going to increase this product because we got increase in cost, right? So I would encourage you, you're always looking at your price, you're always looking at your cost. Your price shouldn't be stagnant for years on end unless your costs are truly set and there's no inflation at all. But that's very rare. If you haven't, and the last one, if you haven't implemented a price increase in a long time, then that's a red flag, your price is too low. Now, what happens if your price on the other end, what happens if your price is too high, right? So if your market, if your price, if they're not accepting the product, right, then you're going to have to work on either differentiating your product from your competition in the mind of the buyer. So is your product a better quality? Is it more personalized? A lot of companies I've been seeing have things like, what I saw in a pickle jar that it was gluten-free. I was like, well, that's great. I thought, maybe I'm wrong, but I thought pickles were gluten-free anyway, or potato chips. So what differentiates your products from the competition, right? What makes your product different where they're going to want to spend that higher price if your price is too high? If you don't have anything that differentiates your product, that makes your product worth more in the eyes of the consumer, then you might have to accept a lower margin, right? A lower margin is okay. If you go below, remember that line I had? If you go below that line that we had of the direct and indirect costs, then you're actually losing money, right? And so that's why it's important to know what your pricing is, because I have businesses that come in and they don't realize every product or every service that they're selling, they're losing money. And that's what you need to know. So if your price is too high, you have to decide, do I want to accept a lower margin than I wanted? Maybe in my price I had a 20% margin, so maybe I'll only go with a 15% margin. And what does that mean to the price? Or you decide not to offer that particular product or that particular service. You discontinue it. Or you can look at your cost, your direct cost or indirect cost, and you have to reduce those costs to bring your price back in line when you do your calculation. Right, so you could try to look at your cost. Maybe going from the 10,000 order to the 20,000 decreases the cost, so your price can come in line again. Right, so there are some ways to tackle if your price is too high. Now, if your price is too low, remember, or how to get to a lower price. And we're going to work off of what we just said. So look at the direct and indirect cost first, right? That's where you can cut things relatively easily. I shouldn't say easily, but that's where you can, it's the most straightforward of where you can cut things. Can I get a better insurance rate, which will decrease my indirect costs? Can I get a better vendor to get me the materials? That'll lower my costs. Is there discounts on bulk ordering? Can I reduce my labor time? So is there a machine that I could buy that could reduce the labor time in half and then be an ultimate savings, even though I'm buying a machine? Right? Or a lot of businesses, they get overloaded. Maybe I need to hire someone, right? Maybe my time is better served doing something else, and I can hire someone to do this. Or you can try to join forces, right? You can join up with a co-op, an association, or a partnership to try to get lower prices. And that could be, you know, you decide a bundle or share marketing or whatnot. So there's a few different options that you can on how to get a lower price. As I said, I'd be remiss if I didn't add something about COVID, right? COVID, we've seen some very interesting things happening with pricing, right? And a lot of this is demand and supply. Some industries are affected more than others, and it's both ways, right? So toilet paper, demand and supply goes way up, or the demand goes way up rather, and supply stays the same, so the price goes up, right? So we've seen some price gouging going on. Or the reverse, you know, baseball stadiums, football stadiums, they're all on the other end of the spectrum where they're closed, or music venues, right? They're on the others. So not a lot of demand, but again, supply. So this could affect, and so you want to look at your supply chain because that could affect your pricing. And where it affects the pricing is it costing you more? Is there more insurance costs? Is there a higher cost in your supply chain because now there's, you know, bottlenecks, right? How is my industry affected? Is it not affected? That'd be great. But if it is affected by that demand and supply, how does that bake into my cost, right? And we're going to get to how that bakes in a second there. Mode of operation, right? COVID safety measures, and there's really three different ways COVID is affecting businesses. One, it affects your industry in general, like restaurants or whatnot. Two, it could affect your workers, as far as a worker could get COVID and have to quarantine and not be able to work for you, right? So how is that going to increase your cost? Or your clients could have to have some kind of safety measures, or like restaurants, you're limited to how much you can actually create in revenue because they're limiting how many seats you have. So that's going to change your projections. Remember those projections that we had? That's changing all the projections because now your total sales volume is going way down. So the same amount of sales has to cover possibly the same amount of cost. So now your price has to go up. So the exercise of getting to your price is not one that it's not a one and done. You're constantly going to be looking at deals and looking at your price and your competitors and your core market. You're constantly doing this to understand your price and to make sure that you're at a good price, because the world does not stay standing still, right? It's continuously changing. Now, with that being said, with COVID in particular, I've seen businesses addressing it in two different ways. I've seen some businesses who are adding what they're calling a COVID surcharge to their products. And that is an additional charge, kind of like, you know, the product or service plus the COVID surcharge plus taxes equals whatever. And it's a separate line item that they're adding so that they can show people, oh, this is the cost of COVID, right? And/or I see companies doing just a general price increase because their costs are increasing. And there's pros and cons to both if you're going to approach the COVID situation in either way, right? With a surcharge, the clients do know exactly how much the price is, is increased due to COVID. It's also easy to change. It's easy to go up or go down or to eliminate altogether, right? So you're being very transparent when you do if you were to do some kind of like surcharge for COVID. I favor the price increase, right? Because overall, if you're doing what I advise you to do, which is incremental price increases throughout the year, then this just means you're going to do a slightly larger incremental price increase to show that there's increased costs to doing business, right? And we're showing that it's an increased cost that's going to be a long-term thing, right? So the COVID surcharge, I agree with if it's a short-term thing and the COVID surcharge is going to go away at some point. But if this is now just, I hate saying it, but the new normal, then price increases might be more apt towards your clients. And you also get less resistance from clients if they don't see that extra line item for a COVID surcharge, right? So price increases, you can just incorporate into your regular price increase, which you should be doing regular price increases. Again, the timing is up to you as a business. And you tend to get less resistance of people asking you what the surcharge is about. So that's where I tend to go. But I've seen both, or I've heard of both being done for COVID. So COVID is a wrinkle, but we do have to address it because it is a reality, right? And before we get to questions, there's the final takeaway, right? There's two basic principles of pricing. So if you didn't get anything else from the webinar, these are the two things I want to make sure you take away. The market, not your cost, determines the price at which you sell your product. So it's what they're going to, what your clients are willing to buy or pay for is what is going to ultimately decide the price of your product, not how much it costs you. That's why you need to know what your costs are, because you don't want to lose money. And that comes into the second point. Your costs and desired profits only establish the floor below which you cannot sell or make a profit. So you need to know what is your floor, what is it that you're willing to do, because then you have to look at the competitors and what your clients are willing to pay to understand, hey, am I a viable business? Are people willing to pay that? Is there someone else making something better for less? Right? Those are the two rules of pricing. All right, let's get to some questions. And I'm just going to leave the how to contact the SBDC up. If you want advising from us, go right to our website. There's a request advising button, which you can see on my page here. So you can get one-on-one advising with an advisor, or you can call and make an appointment. I would highly suggest just doing the website, signing up through that, because it's a little faster, because we're not in the offices these days. We do check the voicemail, but that will get you right into one of us. So let's see what some of the comments were. Pull it up. We got a few people saying. Let's go ahead, Paris. And if anyone has questions, feel free to throw it onto the chat. Still not feasible to see a potential business. Okay, I don't see any questions in the chat. As I said, it is being recorded. So I know at one point we got into a lot of math, right? And that's where I tend to lose people, because I have to explain some concepts and then I jump to the concepts and I have to go back and explain some more and jump more. So it's a little bit of jumping around, and that's when I tend to lose people, when we throw the jumping and the math in together. But it's being recorded, so oftentimes I have a lot of people that go back to the recordings and like, okay, I'm going to stop it, figure this out, then play it again and go back. So feel free to do that. Where do I recommend looking for industry pricing? My secret is Google. Google tends, if you look up, just do industry average. Remember, it does matter if you're looking for industry average profit or industry average markup, right? And that's why we went through the two different terminations, two different terms. So you just do a Google search for industry average, whatever your industry is. So jewelry industry average markup, or jewelry industry average profit margin. right? Or request advising, and we can try to pull that research for you as well, right? But the internet, or if you have an association. So if there's an association, oftentimes the association will do reports, internal reports, and they'll collect a lot of data from anyone who's a member of the association, and then they'll put that data into a report, and they'll make that report available. So sometimes you can go to association web pages or association reports and get that data as well. Let's see how did chat come up here. Where do you recommend looking for industry pricing? Great things. Okay. Yeah. Okay. Any other questions? I know pricing is one of those things that once you do it and you understand it, you're thankful you did it. But before you do it, it seems like a big thing to tackle, right? And the fact that it never ends is not comforting either, right? Competition is going to come and go, so you constantly have to look at the competition. You constantly have to look at your industry because there's efficiencies in your industry that are being created that might lower the cost, or regulations that might increase the cost, right? So pricing is something that you're constantly going to want to look at for your business to see if you can get better pricing, right? The constant business owner is always asking their vendors, if they're a product-based business, they're always asking their vendors, or they're always looking for new vendors, right? So they're always asking their vendors if they can get a better price and what that is, or they're always looking for new vendors. If it's a service-based, you're always looking for, how do I deliver my service easier? What other efficiencies can I get? Or how do I stay on top of the competition by offering more advanced things or the latest industry knowledge? So they say it's well known, you as a business owner, you're going to wear a lot of hats, and pricing's one of them, and understanding that. Well, I hope you guys enjoyed it. It's hard. These things are hard because I'm used to presenting in front of a whole group of people live, so I get the feedback immediately. When it's not live, it's very hard. It's just a wall of silence. Let's see, I think I had a chat. Okay. As I said, it's being recorded. If you do have questions, you can always email me, and you can do that through the request advising button, and it'll ask you for a particular advisor, and you just say Pete Harriman, and I can work with you. Or if you just want an advisor in general in your area, it does it by geography, so it's going to match you up with whoever's closest. And then if we ever do get in person again, then you'd be going to the office that's closest to you. But yeah, I guess. I hope you guys enjoyed it. And I'll stay on a little longer for anyone that does have questions. Niche markets. Okay, so we had a question on niche markets, which I can assume is maybe a market where you are doing something so unique that it's hard to find competitors, maybe. And so with that one, the 3 steps, the cost basis, you're still going to do, right? So you're still going to understand what your cost is. Now, if it's a niche market that's a service-based niche, that's a little harder, right? Because you don't have any direct costs to really look at. You still have overhead costs if you're a service-based business. You still have overhead because you still have the cost of possibly how much you want to make for a year for labor, or the cost of insurance or rent or utilities, whatever your office might upkeep or whatnot. So you still have that cost basis that you can do just to get your floor, to understand I can't charge less than this in order to make money. And that involves doing projections and doing projections of sales and projections of cost. But when you look at your competitor section, if you're in a niche market, you might not find any competitors. So you might be in a unique space of what do I do? So one option is you could find not the same because it's a niche, but a similar type product and see how they differ. to see how you would differ. If you're new to the market, some ways that I've seen people enter markets is they have a introductory price into the market with the understanding that the price might be, so let's say they have a service, and to enter the market, they're gonna price that service at $100, and they did their costing saying, yeah, $100 would be fine for covering my cost. Let's say $100 and is for now, for the introductory, we're a new business, we're doing $100, but the price is usually $125, right? Because $125 is kind of where I want to be, but I want to make a splash in the market and see what my competitors do, or not my competitors, but I want to see who bites for core clients. Because remember, I did that core client research and I understood how much they might be willing to part with, right? And my core clients, my research for core clients is, what is their income? What are their likes and dislikes? What other products are they buying? And what price points are they? That's all part of the core client research. And we can help you with that too, of who is my core client and what is their income, what are their buying habits. So you could enter the market with a lower price with the understanding the price is higher. And then if you're finding a lot of traction, getting a lot of stuff, then you could bump it up. You could say, okay, the introductory offer is over, we're going to this price. Or if you find there isn't a lot of traction, then you could keep it. We could say, okay, the introductory price is the price. But again, you need to do that cost analysis, and you need to do that core market analysis. Even if you don't have competitors, because it's a niche market, you still need to understand what your core market is willing to spend, right? And this could be a survey out to you. So you could get a group of remember that introductory price. Part of the introductory price could be completing a survey. And part of your survey is saying, how much would I expect to pay for this? Or what value do I see? Is it good value? I would have paid more, I would have paid less, and so you get a survey back. And as you get that survey back, you can then decide, do I want to stick with the introductory price, or do I want to go up in price or go down in price? How do I do that? But the cost analysis and your core client analysis both have to be done still, even if you're a niche market with no competitors. Does that make sense? I hope. Again, I'm not used to not having the live feedback. Let's see. Oops. I'm gonna stop share. Come to here because it's easier for me to see the chat questions when I do that. Okay. Is there an optimal percentage of profit to set aside to reinvest in the business or set aside for an emergency fund? I get this often asked a lot, especially about like some kind of contingency fund. It does depend on your industry. It depends on your costs. It depends on you, the business owner. Some people go to bed at night and having $1 in the bank account is fine with them. And some people aren't happy with that, right? So there is no optimal percentage, really. If COVID's taught us anything, most people now, from what I'm understanding, are looking at getting either a 3-month or a 6-month of expenses reserve, so that if there was a shutdown, whether 3-month or 6-month, that they'd have that. Now, how doable that is for a business is up to the business, because some businesses might not make enough to put 6 months into a bank account and not use it, right? Me, myself, because I'm conservative, I tend to look for the 2 to 3 month mark of being able to cover all the costs like normal for 2 to 3 months. Now, why it's also industry specific is some industries it takes longer to get your revenue. So if I'm in the construction business and it takes 9 months before I'm going to see the pay, well, that might change how much I need in the reserve, right? Because maybe now I need to cover 9 months worth. If I'm someone who has direct point of sales and I get the money immediately, well, then I can probably shorten that because I don't need as much, right? Or it's not going to take 9 months to get my money. It's going to take a day or two. So that's a hard question I get asked a lot. If it's a hospitality industry, then you're going to want to look at your cycles, right? Your projection of sales. And so if you do your 1-year projection, let's say, you're going to see how much you need to survive the winter. Like assuming, let's assume that you have a summer business and the winter is your dead period versus the reverse. So you first need to understand how much you need just to survive the winter. And then you're going to want to say, okay, worst case scenario, I see a lot of businesses do what we call a stress test. They say, let's say worst case scenario, 20% of my business doesn't come through like how I thought it was. So what is 20% of my sales to be able to get me through, right? And can I make enough money to put that aside? Or, and this is why we're always doing projections and always looking at them as a business, we need the canary in the gold mine. If things are starting to go off, we need to know as soon as possible, because it's much better to approach a bank before I miss a payment than after I miss a payment. So I do not envy business owners, because there's a lot of hats you're wearing and there's a lot of constant updating that you have to do as far as keeping on top of everything. So for the hospitality, it's a little harder because, especially COVID right now, a lot of restrictions put in place. But part of it is also your gut, right? Of what am I happy with for my own reserves? I'm conservative. I like to have a couple months at least. Some people are fine skin of their teeth. Some people are fine with a huge reserve. And then you get into arguments on, is that money well spent if it's just sitting there, not earning? So that was my answer and non-answer. There is no optimal percentage of profit. You know, it's all specific to your business and yourself. All right. I'm not seeing any more questions. Kelsey, I'll hand it over to you.
Awesome. Well, thank you all so much for joining. I've got kind of intense light right now. Sorry about that. I will be sending out a follow-up email once all of this is processed with a link to our YouTube of the recording of this and the slides and any future webinars coming up, so you can stay invested and included in all of this. Thank you again so much for all of this. Good job, Peter. Thanks. And I hope you have a great afternoon.
Yeah, as I said, feel free to reach out. We're a free confidential service, so that's what we're here for.